Hello, everyone, and welcome back to the practical application part of the module 4 of our all-new Blueprint Strategy course, Market Timing. And today we're going to cover precious metals, including gold, silver, as well as palladium. Last time we talked about the equity indices, and what I did on the Blueprint cheat sheet, I created another column here. I added another column and I called this asset group. So I could group my markets within my asset groups. So here I've got my equity indices. And so we can see we looked at interest rates, we looked at the true seasonals, we looked at the yearly roadmap, we looked at supply and demand. And here just some notes, and they're all the same for all of them, which are 30 and 10-day cycle trend following, as well as 30-week cycle low buys. Then October, November, December is a must buy based on true seasonality. Then we look at the yearly roadmap. Then we also look at the .D charts. So these are our additional notes for equity indices. And now you've got your cheat sheet in terms of, okay, this is how I need to approach that specific market. And now we're going to talk about silver, palladium, and gold. And you can see we already touched on these markets right there, right? But now I want to put all the puzzle pieces together and look at them again one by one, just like we did yesterday or the last time we spoke with our equity indices. So let's just start with gold. And as always, we start at step 1, which is location. So location, let's start with current price, which is right there. Now, if you ever want to pause and do the analysis yourself and then see if your analysis is as per my analysis, but you may be further time may have passed and you may look at this 1 month, 2 months, 3 months down the road, but you want to get some practice in and see if your analysis would be the same as mine. Then what you can do is you can go to time frame, customize, and then here you can check the last date. So you can say, well, today is the 21st of June, 2023. So if, for example, you're at the 30th, or you're in May 2023, or you're watching this maybe even in 2024, and you want to align, you want to do the analysis before you watch this video to align it to see, okay, where you may be wrong or where our analysis may differ, then you can use the last date and you can put it to the 21st of June 2023, and this should put you right to this chart layout. And now you can do the analysis yourself, come back later, and then overlay your analysis with my analysis. And this would be a good way of practicing for you, right? Because once you see me do something, then already your eyes are trained and your eyes will trick you to see the same thing. While if you do it yourself first, maybe you see different things, right? Maybe you see different things. So just as a side note, but let's get into it. So let's start with supply. And what's worth noting here is that I am using the @GZ equals 120xn plus GJMQZ. Okay, so this is a custom chart here. Once again, I'm using that. I'd like to use that more than just using the @GC chart, but the @GC chart also works just fine. So use what you've got. If TradeStation will allow you to put in this custom symbol, then do that. If not, then @GC just works fine too. Here we can see that, going back 30 years in time, just really quickly, we can see that we are pretty much coming from just all-time highs, right? So this is going to be important for me just to understand that, okay, if I'm going to look to the left, I can go back to 2001, it doesn't really matter because I will not find supply there, because it's just we're working at all-time highs here at the moment, or at least we're coming from all-time highs. So the only supply that I have then is this messy supply up here on the weekly, right? That's all I have. I don't have a lot more. So what I would do here is kind of everything that looks like a level is a level, apply that rule, understanding that this is support, it's an all-time high, and that the leg out may be quite nice here, right? We've got 2 large weekly candles here on the leg out. And so this is all I've got. And it doesn't get much better than this. Well, it would get much better than this, but for this chart, for what we're seeing, this is the best we got. So we work with what we've got, is what I was trying to say. Now we look at demand, and already what I can see, well, this is quite a nice candle right there. So I'm gonna look at this right here. Something that I always pay attention to, and that may be an advanced setting, something that I'll write down, an advanced way of looking at price charts is always looking at traps. And what traps are areas of supply and demand that are situated right below or above obvious pivots. Support and resistance. So you want to write that down just in general. This is something that I'm always looking at when I look at my zones is, okay, I know that I have demand here and I know that looks quite nice, but is my demand situated right above, well, at an area of a obvious pivot, and therefore right here, and therefore may I have a trap area right below where I have some demand coming into play here as well, because that is going to be troublesome, as this means I may have to enlarge my window of opportunity right here, because I have so many levels that are situated on top of one another. But what's interesting about these trap areas is the following, and you really want to note this down. What's interesting about these trap areas is, let's say right here, what we're looking at is kind of this picture. Right? So we're like, hey, this is the first obvious demand, right? It's so obvious. But the problem with that is it's so obvious. We also have a pivot area right there. So what most people do is, and what we would do, right, is we would look to enter somewhere in demand, right? We would look to enter somewhere and maybe even lower, but where would our stop loss? Our stop loss would be right there, somewhere below. So most people will have stop losses right below pivot areas. Now, if we're buying to enter here, our stop loss will be a sell area. The issue with that is that this may be an obvious trap area that institutions will use purposely to trap people with the sell orders so they can get their buy orders filled, right? So if you imagine they want to get as many buy orders filled as possible down here, what are they going to do? Are they going to go with an obvious pivot area here that a lot of retail traders may be trading as well? Because if we see that, very likely is other people will see that too. Or are they just going to break that area, stop them out, which will allow them to fill more of their buy orders and then go up higher? This is often something that I'll see. On top of that, it's not just the people that buy and will be trapped with their stop loss orders. It's also the people that will perceive pivots and then and then they see that, and they will say, well, if price goes below, I'm going to have a breakout order sell, because that confirms that, you know, the trend is changing. So they will do a breakout sell, and then also their sell orders is going to be trapped here by institutional orders. So we've got a scenario here that where if we come down, this is kind of obvious, right? So the question is that going to hold, or is price just going to go maybe down a bit and then stop all those traps out, stop all those stop loss, stop out all those retail traders with their stop losses, which means they can buy into their stop losses, right? Sell orders, retailer sell orders, institutional buy orders, they buy their stop loss orders. So that's the exchange, means it's a trap, right? So areas of supply and demand that are situated right below or above obvious pivot, support, and resistance. So there is a demand that's situated right below an obvious pivot area, which is something we just need to have on the radar. It's very important. It enlarges our picture, but it also means that we may be able to see that and anticipate that, or at least have that on the radar, that once we go into the lower time frame, we may want to look slightly below here as well. And then it kind of depends later on the true seasonals, how aggressive we're going to be in terms of buying this, right? Because if we're down here and we're nowhere close to a seasonal low, we have time. But if we are here and, you know, the seasonal low has already happened and we want to be really aggressive, then buying into that demand is already possible. But for now, this is not going to tell us a whole lot. Well, what should we do? Should we now buy the lower or the upper? We don't know that just yet. Price is still very far apart. We still need to look at the COT, and we also need to evaluate the true seasonals to really get a roadmap in terms of, hey, when do we want to position ourselves? And therefore, what is the demand area that we want to focus on in that case? So to be safe, what we're going to do is we're going to just have both drawn in. However, right? However, what I'm going to do when I draw my location is I'm always using the first areas. So the first supply to the first demand. Otherwise, my location area is gonna get skewed big time, and it may mean then that my equilibrium will may start, you know, within a demand area, which I don't want to happen. So I know that this is very low, and then below that is even, you know, that's then a trap low. You could call it like that. But so I'm just going to show you that. Just maybe it's a little bit vague if I just talk about it. So right now, looking at distal to distal, first demand to first supply, I've got a clear equilibrium here. That's a very clear equilibrium. And I also have a clear low. And then a clear very low. Now, the problem is, if I'm now going to put my area here or even lower, then all of a sudden it changes my equilibrium and it changes my low. So in this case, we're not reaching the very low, but if we were to go lower, right, it would continue to skew our picture. And then all of a sudden, our low should be our very low. And so this cannot happen, right? So what we want to do is we will always want to use our first ones to have a clear equilibrium, and then to have a clear low and a clear very low. And then you could call this a trap low. And just to have that on the radar. That's now a little bit advanced, but this is how we need to look at the markets, right? This is how we need to look at the markets. You always need to think about, hey, supply and demand. It's not the, it's, you know, a lot of people are aware, well, institutions are aware of how, you know, retail traders, educated retail traders as well, how they trade. So oftentimes we will see trap areas. Oftentimes we will see support and resistance areas being broken just so that we can then see price going in that direction that we had planned price to go to. So obvious support and resistance areas are always something that we need to be really cautious about and protect ourselves with trap areas. In this case, on the upper end, I don't have a trap because it's an all-time high, right? We talked about this. So let's just move on now into our trend chart, and then also looking at our beautiful commercials and our retailers. So in terms of trend, I think let's just double check that against the zigzag. Yep, looks about right. The only change is kind of here, but doesn't make a difference to me. So what do we have? I would say we have one higher low. We have two higher highs. So we don't have an uptrend yet, but we may get an uptrend in the near future if we get another higher low. So we could anticipate another higher low to come into play within weekly demand, right? Within this area, maybe we can anticipate another higher low, which then we can anticipate a newly formed uptrend. You may even argue that, hey, you know what? My common sense would tell me this is an uptrend. Even though I don't see two clear pivots, this is kind of uptrending, right? Because from November 2022 all the way to today, which is 6 months, which is half a year, we're moving up, and very steeply so. And we can see the impulse is up as well, with the correction moves being very slow. So we can argue, hey, this is, you know, we can argue for sure that price is stronger. We can argue that price is definitely stronger than it's weak. So in this case, even if you were to argue this is an uptrend, and your argument would be, well, look, you know, I know we don't have two higher lows, but man, we've been uptrending for 6 months, right? Price has been going up steeply for 6 months, and the impulse is clearly up. So here we could also say, well, experience versus your black and white objective rules. Both here would be right, but at least what you could say, if you were to follow the black and white rules, you would say, well, still the impulse is up. So technically speaking, what I would rather do is I would look to buy rather than to sell, just based on technicals, right? Just based on technicals. What we also have, however, from a larger picture, and I don't want to draw this in, but I'm just gonna maybe do a drawing here. From a larger picture, we could also kind of argue, right, kind of like a sideways trend, where I've got my resistance area up here somewhere, the all-time highs, and I've got kind of demand coming into play, or support down here. And so we could also argue this is a 2020, this is a 3-year sideways trend. And I could argue that within that 3-year sideways trend, I will find uptrends and I will find downtrends and I will find uptrends and I will find downtrends, right? So, and every time there's like, hey, now there's a downtrend and price changes. And every time we're like, hey, now there's an uptrend, then price changes. And here's, well, there's an uptrend, then okay, may price change now. So we need to be aware of that as well. And what's going to lead that are the commercials. So we need to look at the commercials and what they do. So from up here, their last extreme was a selling extreme. Okay. So from down here, yes, we wanted to sell and the retailers were also buying. So yes, we wanted to sell. And unless they flip-flop here, we're still going to look to sell, right? We're going to off of their prior position. We're going to base our analysis on their prior extreme, which their prior extreme was not the high, right? If the prior extreme was the high here, then we would have been buying until they're at that extreme. Now their prior extreme is here. So we're going to base our analysis on their past extreme, which is a sell extreme. And then the retailers were buying. So this means that we can look to short unless this picture changes, right? So if and this is something that we need to observe now, if the commercials are going to move back up higher, once they're here, man, we're going to be pretty aggressively looking to buy wherever price is at that stage, right? Ideally aligning then with the true seasonals as well, and then happy days. So that's something that I would look for. So COT again is very important for us to look at. And then the non-commercials are also kind of important here, but they are doing what we would expect them to do. They're kind of following price and also creating no divergences whatsoever. And so there's nothing that we can read off of the non-commercials at the moment. They may be uptrending though, right? They may be uptrending though. So here is going to, once they reach that area, that's going to be quite interesting for us to see. Something that really predicted the end of the band here is as here we saw a divergence, right? So here the non-commercials made a new high, even though price made a new low. So here this was a fake low. The non-commercials, the commercials here were really coming from an ultimate extreme. And so this divergence here was kind of like, hey, the non-commercials are not having it. This is a fake low, potentially a big buy. And now they're holding their lows. And of course, that's now shown also in within price. They're holding their lows. And as long as these lows are kind of holding here on the way up, we should follow that uptrend, right? We should follow that uptrend. So now what did we say? Well, we said based on technicals, we want to be bullish. Based on fundamentals, at the moment, we can just be bearish. So based on technicals, we can be bearish. Based on fundamentals, we should be. Based on fundamentals, we should be bearish. Based on technicals, we should be bullish. So technicals, we should be bullish because the impulse is up and the trend is up. And so we want to buy low. And the fundamentals tell us, hey, for now, if we get up higher, look to sell. But if this changes, if the commercials are back up here at the buying area, then of course we want to buy as well. So we always kind of want to do what the commercials are doing here, and what we said here for gold as well, right? COT is king. So December, January, February must buy. And also now something is coming up in terms of the true seasonals, but we need to inspect that now. So the true seasonals, as you can see, price is kind of following those true seasonals very closely, right? We're going up, then we're coming down, then we're going up a bit. Now we should be going down, down, down. And then from the 7th, well, from the 19th of July, we should see a huge rally of price. Okay, so in and around that time is really the second best true seasonals there are for gold. So mid-July, must buy. Also mid-July to, I would say, end of August, September. And of course, that we are looking for the alignment of the COT here as well. That's clear, right? COT is king. So and now we've got a roadmap, right? We said, well, based on the fundamentals, we can look to sell. And so we can look to sell, yes, but only until the 19th of July. At that point, we want to be buying. Okay, so since we're planning now ahead of time, let's now plan a buy for the 19th of July. This is still some time until then, so we can really prep this ahead of time. And before we buy, though, then right, we can always speak about the default setting or a set. But before we then before that trade then is triggered, ultimately we still have to evaluate again the changes of the COT. So I'm only going to buy on the 19th of July if the COT is bullish to me, right? If the commercials are buying, that's it. If the commercials are buying and we're on the here in mid-July and the commercials are buying, man, we better buy. Where are we gonna buy? Within any of those weekly demand areas. So now we have kind of transferred all of this into the charts. And what we basically said is we want to buy down here on that date if then also the commercials are buying. Okay, if then also the commercials are buying. So I want to now create my window of opportunity from here to here. And I want to transfer this here and then look at my lower time frame rules if I find anything within that space that really makes a lot of sense. So first help line 1900. That's going to be my low. Second, and then my low is going to be 1778. Okay, right here. So this here is going to be my window of opportunity. And within that, I'm going to look to find some high quality demand that's going to meet our zone qualifiers, our lower time frame rules. So the first candle that I see here is going to be right there. That's an explosive candle. Then we've got another explosive candle, another explosive candle. So already what I'm seeing here is a drop-based rally here. Now, a drop-based rally based on the preferred version, as I would put my proximal on the highest body of the basing candles and my distal right there, what's going to happen there is I have a level that's only $6 wide. So I think we can see that this is going to be extremely narrow, right? And so what I'm going to do in this case is I'm going to put my proximal on the wider version of the base, right? So on the highest wick of the basing candles. And I'm doing this because based on the preferred, this level would just be too narrow, okay? And what I'm also going to do in this case is, because I have this wick just below here, is I'm just going to put my distal on this wick, right? Because anyways, if I was to set something like that, just giving me additional coverage, I'm just going to put it right at that low of that entire formation. So it's kind of like, okay, we see a drop base rally here, but I also see a drop base rally overall. So if I'm going to put my proximal here, then might as well just put my distal there, because it's very close there anyways. So I'm just seeing this overall U. So I'm just using a little bit of advanced zoning here to use the wider version as a default in this case, because otherwise it's too narrow, and then protect myself with the overall pivot here of that low, because we're anyway so close, right? We're so close. So, and now I've widened my level a little bit, which is also good, right? I want to give myself more chance to be in this trade, and B, stay in this trade, right? And so we give ourselves more chance to be in this trade by putting our proximal higher, and we give ourselves more chance to staying in this trade by putting our distal lower. So let's look at departure. Departure, I think, it's not going to be two opinions about it. This is a very steep move. The base, we've got one candle in the base, and it's a quality base. Say yes. Is it fresh? Price has never come back into the zone, and even on the wider, right? Price has never been in here before. So yes, it's fresh. Is it original? And what about a flip? Well, it's a drop-based rally. So remember, our U-shapes, they're usually not original, because here, as I look to the left, I've got another drop-based rally. And as I look to the left, I have a rally-based rally. So here, I kind of have rally-based rallies right there. That may be the origin. Here, this may be this rally-based rally here, the messy one. This may be the origin, and this may be the flip of things too. So this is the origin and the flip, because we had a pivot here. And this here is non-original. It's non-original. And it's not a flip. Now, do we have a level on top of level? Let's check that. Where would our level on top of level be? Well, right, what do you see here? Not a whole lot, right? There's a gap here anyways. That's quite interesting. And usually that's also something that you want to do. You want to just outline your gaps within the chart. There's a gap too, because those gaps may or may not get filled, but usually gaps are filled, right? So in this case, I can also see there's a huge gap just below the low of my window of opportunity. So do I have a level on top of level that's clear where I could even say, well, this is everything that looks like a level is a level? No. I have just two huge gap areas, and the next level that I would find would only be here, right? So if again, I would put in a from here to here, if I would put a large green candle, then I would have a level here. Now, these two levels are very far apart from one another, right? They're very, very far apart from one another. So it's not really a level on top of level. It's not really a level on top of level. How about higher time frame coverage? $18.28 is $18.28 right here somewhere. So yes, we're covered, but we're only covered with support. We're not covered with the trap. Okay, higher time frame coverage. Yes. No trap coverage, which is not that ideal. Ideally, I would have liked to have a level on top of level where the trap area would be covered. Now, let's look at some additional rules here. Profit margin. How far has price traveled away from the zone, measured by preferred to distal? Well, 1 to 10 maybe, right? To all the way to up here. So that's solid. And arrival, I don't know yet because price is still very far away from that area. So we need to look at arrival maybe still a little bit later. So in this case, we've got some demand right there. Right, we've got some demand right there. And then we have another demand area right there. And that other demand area is situated below all of those gaps, which is something that I quite like. But already this may be quality, but there's so much noise below here that may be troublesome. So whenever I have noise, and what I mean by noise is all of this is noise and it's below my level. And when you have noise, it's making your market timing more difficult than it should be. And whenever you see that, just be cautious in terms of, okay, maybe we don't just want to straight up set this. Maybe we want to observe how price arrives here. And then depending on what you're going to take this trade, depending on true seasonals. So this is where I really like to have my true seasonals kind of within the chart, because at this stage right now I can say, well, if as we get closer to this date, the more aggressive I'm gonna be in terms of setting this. So let's say price is gonna come down and then it's gone through the seasonal low and price is here, then I'm gonna set this as is because I'm already within that time period, right, where I want to be extremely bullish. Right? I'm gonna be within that time period. However, if price is gonna go steep decline and it's already there and we haven't even reached that phase yet, then I'm gonna set the next best one. And then the next best one would just be this one, right? It would just be this one. So it depends on what price is gonna do from here to here. that's going to give you a roadmap in terms of what do you want to set. You always want to set the one closest to your true seasonal low. Also, your true seasonal low here doesn't mean that we have to get a low necessarily within the price charts itself, right? We could just might as well go up higher here, and then that just means we get a good buy point. It's the best buy point. But ideally now what's going to happen is that we do get a decline here. And then as we get closer to the true seasonal low, the more aggressive we're going to get in terms of buying the next best demand zone that we can get our hands on. Right. So we now spend quite a lot of time on gold. And there's one thing, there's one additional asset specific rule that I want to point out here. And that is the net commercial net long buy. Right. And so what we want to do is for gold and silver every now and again, especially when we see that, well, right now we don't have to look at the nets, right? Because we're not going to be close to a net long mark. We're only going to be close to a net long mark if also the COT is above the green line, the commercials are above the green line, and they're bullish. And so what you can do is you can just add here you can add the COT users and producers, and the net long, remember, based on the nets, is going to be whenever price goes above the zero line here. So if the commercials, if the exposure goes above the zero line, they're net long. If they're below the zero, they're net short. Okay, it doesn't necessarily mean net short and net long, usually doesn't matter, but for gold, it just so happens that the net long positions that were shown in the past led to multi-year bull markets. Okay, so here we were net long, here we were net long, here we were very close to being net long, but not properly net long. And then here we were net long as well. So if you're gonna look at these areas and you're gonna say, well, what are the absolute best times to be buyers in gold? And what creates these large bull markets is net long readings. I mean, this, yes, is so far back, right? But mostly these two prior readings here and here, which these net long readings created multi-year bull markets in gold that have manifested itself. So if you ask yourself, well, what created these multi-year bull markets in gold after this multi-year bear market, the only bear market in gold ever to have existed, and what has created these bull markets is if the commercials go net long. So if the commercials go net long, or they go close to the net long area, here they were very, very close, only a couple of thousand contracts away overall to being net long. Here, right, only a couple of 1,000 contracts away from being net long here. So they were at minus 50,000 net overall. And that created that uptrend that we're seeing here. And so if we get close to or towards that net long area of the commercials, man, we really want to pay attention to this. And if you are, for example, someone that likes to buy and hold and invest for the long term, and you're also maybe interested in diversifying yourself, then the times to be a buyer in gold is when the commercials are close to that net long area, right? That's when I'm also happy with you going out and buying gold bars and putting it in the vault or whatever. If you have a lot of money and you want to diversify your portfolio and you don't believe in, paper currency and fiat money, and you're like, what's going to happen to all of that? I want some gold in the vault and maybe some silver. Whenever the commercials are at the net long areas, and they are from time to time, then you buy gold, right? Then you go and you buy your gold bars. So what we're putting there on the precious metal front for gold is what we also want to look at is net commercials, net long. And when they are, we want to be paying attention to that. Okay, so we've got everything covered. Just gonna clean this up for us. And gonna save this. And you can also see how much time we spent on each chart, right? And this is really also something that you want to do on your own. Time is really screen time. Spend a lot of time in front of the chart, study everything, study the true seasonals, study the COT and how price and COT interplays, and become an expert at that specific market that you're looking at. So now silver, starting with supply. And demand. Now, the question again, I have supply and demand here, and I can already draw my location area here. I'm in equilibrium, yes, but the question is, do I have trap areas? Well, here I just have a large wig, not really a trap. And then here on demand, I may have a gap that I can see right there. And there is in fact a trap area, as we have demand situated even on the wider version here, rally base rally, right below this pivot area here. So I've got an obvious pivot area, and then I've got my trap demand or my trap low. So I've got my low, I've got my very low, and I've got my trap low. And just to be cautious here, as I have a trap low. So same as with gold. Usually gold and silver, they move hand in glove. They move in unison, but not always and not necessarily always. So we can look at them independently, but most of the time we will look at them kind of combined and then see, well, which one sets up the best. Maybe divide our risk size into both of them, or have a bit of an over leveraged scenario where we may even trade 1x risk on both of them, have an overall risk size of maybe 2 on the table. We would do that during times of strong seasonals and the COT alignment. But other than that, we would just use a normal risk size. For silver, the location, quite clear. And then the trend, very similar to gold again, right? Very, very similar to gold again. Well, the thing is, if I'm taking this, I could also think about taking this here. Let's see what the zigzag is going to tell us. Right. So the zigzag is also taking this as a kind of pivot. And then up here maybe, but I kind of like what I did more than the zigzag. So here having 2 zigzags doesn't really make sense, but having one at least makes sense. Here having one for me personally really doesn't make a whole lot of sense. So I'm going to stick with what we've done here visually. So what do I have? Well, I have 2 higher lows. I have 2 higher lows and I have 2 higher highs. And I can also see, well, those lows usually come from commercials being bullish and retailers being bearish. And so that was a nice area. Now it's flip-flopped, right? So the commercials are bearish and the retailers are bullish, which means we want to sell. And you can see right now price is also declining quite heavily as a result of just that opposite positioning of the retailers versus the commercials. So unless this flip-flops, I'm going to be bearish. But what I want to anticipate is this to flip-flop and then buy with that trend potentially, and maybe even within that trap area here. What was the telltale for that change of trend? Yes, the commercials were selling here, but even more so, look at what the non-commercials were doing here. So we had the same high on the non-commercials, but I had shown a higher high in price. So remember, institutions, they can manipulate price. So we need to know the underlying condition. And here the non-commercials were just not having it, right? They were like, yeah, price is making a new high, but really what they're doing is, really what we should be doing is selling up here. And so this is a divergence here once again, where price is faking a new high, but the non-commercials are showing us true conditions of the market, which shouldn't have been a new high. It should just have been the same high, therefore a fake high. And so great sell opportunity in line with that divergence, then in line with the commercial selling. And now it continued to be a good sell because the retailers are buying and the commercials continue to be selling down there. So all this time it continued to be a good sell, which is also something that we had talked about. But just because you want to sell doesn't necessarily mean that you will get into this market with a good way of also timing the market, right? So, but we have now already looked at quite a lot here in terms of just the condition of the market. And now looking at the true seasonals, what do we want to do? I think it becomes quite apparent what we want to do. And what we want to do based on true seasonals is we want to look to buy from the 6th of July already. The 17th of July, like we had for gold, is definitely also powerful. But here already, it may start earlier. So again, mid-July, this is, we're going to take a this as a ballpark number. We're not going to make exact signs out of this. You know, here as well, we would have said, well, we only buy on the 16th of March, but then the true low came a little bit earlier here at, well, the actual low. So this is not exact science, and this is not lows and highs, right? So here, for example, we had a low in the true seasonals, which just means this is a good buying point. However, price didn't make a new low, right? Price went higher. So at these times, it's even better if we see, well, price is stronger than the usual seasonal, something is really happening fundamentally. Usually the COT already setting up early. Usually when the COT sets up early, you will see sometimes price already skyrocketing before the true seasonal low is in place. And if the COT is not setting up, then usually what we will see is price following that. So at the moment, remember, the commercials are still bearish. So that true seasonal high here and that true seasonal high here, they were good selling points. True seasonal high, good selling point, all the way down there. And then eventually we should look to buy. If the commercials are also buying. So I would say from anywhere from here to here is our window of opportunity in terms of time, a timestamp, 6th of July to 19th of July. So let's look at our window of opportunity here first. Where's our window of opportunity? Below low, so 22,152. So this is my low. And then it goes all the way to 18,740, which is going to be quite a large area. $18,740. Okay, so this is my window of opportunity. So now, simple. Let's look for demand. Let's look for explosive green candles. First one that I see is coming into play here. And then here, and then again, the same scenario that we had previously where in this case, I'm going to take, you can see that already, I just did it. I'm going to take the wider version, not the preferred of that drop base rally, because it makes the zone a little bit larger, which is otherwise just too small. So this is the first zone that I see, right? Drop base rally. This is my explosive green candle, very obvious, visually jumps into my eyes. Now you could say, well, Jan, what about, isn't this also a indecisive candle here? Maybe. Yeah, fine, right? In this case, it would be marginal difference. I would see both. Either you put it here or you put it at the wider version of the basing, the really obvious indecisive candles here. I see both. So even if you were to say I'm going to put it there, fine with me. Only makes a marginal difference. So let's talk about departure and base. Departure, clearly explosive. Base, it's 2 candles or 3 candles within the base, so that's also fine. Freshness, yes, it is fresh. Price has never tested that. Original, it's non-original. It's a drop-based rally. It's a U-shape, and it's not situated at an all-time low, so it has to be non-original. And if I look to the left, where's the origin? Well, I've got a rally-based rally here. I've got a rally-based rally here, right? All of that rally-based rally, that is the original part, and that's created this here within the wider version. So It's non-original and it's also not a flip. No. And do we have a level on top of level? Well, in this case, we just put it in with our I'm going to remove the low end of our window of opportunity here. I can put this in now, the level that we saw, that is the original, and that's within maybe our trap low. And if I have this here, I have a level on top of level, right? So in this case, I have a level on top of level. Yes. Trap low and higher time frame coverage. Let's check that. So my higher time frame starts at 21,395. And I'm at 25. So 25 is, and perfect, right? My 25 here is right below that gap here, that magenta box, 25. And that's that gap here. So I'm covered by that gap here as well with that level. And then my level on top of level, 19,432. 19,432 is the preferred version of my trap low. So beautiful, right? So beautiful. So let's write this down. So level on top of level is, yes, it's the trap low, and then higher time frame coverage, yes, and then LOL, well, lower level is covered by trap low. Now, additional rules, profit margin, we just eyeballing this, perfect, arrival we can look at yet. And now asset specific rule, if the net commercials go net long, we buy. So this is something we're just going to quickly check. But now, generally speaking, again, looking at our roadmap, what are we going to do? Well, you're going to say, well, Jan, what are we going to do now? Well, our default setting now is we set the lower. We set the lower entry stop loss. That's our default. But if price is going to be close by here near that seasonal low, we may already take a stab at the first one, right? So, but if you want to set something, we can set the lower. If price, however, is closing on to the true seasonal low, and this is the first one, and it's not tested at that point, then we're gonna, set the first one potentially already. But this is where, we can do the work before in terms of weekly income, and we can anticipate, well, what's going to happen in the future. But as time moves on and as price moves throughout time, right? Price is going to move throughout time. Right now, we are on the 21st of June. We want to buy in mid-July. So in 2 or 3 weeks time, price is going to move throughout time and things may change. So we need to reevaluate our COT and our levels at that time, right? Which level is closer to price? Am I going to be aggressive or conservative? Are the commercials also buying? And if the commercials are buying, great, right? We're going to go all out here. So that's silver. And now just lastly, those net commercials. And let's put in the net zero line. So here we were net long. This net long reading created that uptrend. Here we were net long, big uptrend, just up until Corona. Here we were net long. This was a big buy as well. And then they've never been net long ever since. So this being the most powerful net long so far, but on silver as well. If we go net long, man, we better be buying, right? We better be buying. So for gold and for silver, we're going to look at the commercials, they're king. Then the retailers we're going to look at as an odds enhancer. For silver, we can also look at gold. And of course, we're going to look at the true seasonality here as well, right? And the true seasonality, you know, if we call it a secondary or an odds enhancer, I think either one would be fine here. As long as we look at it and we align our trades here with that, I think we're gonna be fine. And then here we already put commercials net long as the ultimate buy signal, but everything else, you know, we can just copy this. And you can see those markets, you know, that's why they move hand in glove, because the fundamentals that move those markets, they're very similar, right? And so of course these markets are going to move similarly as well. The one thing that we can look at here as well is we could look at the valuation as a cross market condition. We could check that against gold. I think and maybe a better cycle. So there's a low, then there's a high coming up kind of here, then there's a low coming up kind of here, then there's another high coming up right here, which then creates this drop. But again, nothing that we wouldn't have otherwise known already from the commercials anyways, because yes, we want to sell anyways, right? Because the commercials are bearish. So maybe this is like an additional tool for you to say, well, now it's overvalued against gold. Now I can look, you know, to short in supply if, you know, I find something on the lower time frame, maybe daily income style entry, that would be possible. But other than that, this is not gonna give you so much more information than this. And anyways, if you saw the opposite here, then you see in the commercials, then with the commercials, then the commercials would overwrite that anyways. Now, lastly, let's look at palladium. So palladium on the weekly, supply and demand. Is this supply here? Maybe. More like messy supply, I would say. I like this supply just a little bit better. It's also not too far away in terms of the weekly, right? And so if I go in like this, then I don't even see this here. And this is quite obvious though to me. So I've got some supply up here now, demand. I need a help line now. I've got some wick areas here, and then I've got some demand. All of this is kind of difficult to pinpoint for me because, well, there's a rally-based rally, but maybe there's just a rally-based rally here too. And so all of this is kind of a base here. We may be able to refine that if we say, well, this is also kind of closer to that flip area here, right? So, but somewhere here I've got demand for sure. And it's a rally-based rally. So I also am not going to have major trap areas below. So distal to distal. Oops. So right now I'm in equilibrium, not quite in low, not quite in very low. So still in equilibrium. Now I think trend is gonna be a no-brainer here. Trend overall is gonna be down, right? So we have 1, 2, 3, 4. This is how I would draw trend. And so just a little bit cleaner, right? We've got these clear lower highs and we've got these clear lower lows as well. And what we spoke about right in the beginning of the blueprint course is we had looked at this kind of low right there. And we said, well, we anticipate a rally. We said we anticipate a rally because the commercials here were super bulls and the retailers were bearish. So at the moment, it seems like we did get a couple of weeks of a rally, but we did not yet quite get the move that I would expect to happen. And now the commercials go back into that extreme. So what's interesting with the non-commercials is in this case, the non-commercials, they are making the same lows, they're holding the lows, but price made a new low. So this may be a divergence, which if that divergence eventually plays out, right, maybe another fake low and then we go higher. If that divergence plays out, then this is a massive telltale for price moving higher big time. So this is something that needs to be observed though, week after week. It may change. The non-commercials may dip lower as well with price going lower. But if they don't, then that's going to be a telltale for us to go long. Now, when do we want to go long? Right around now. So beginning of July, end of June, we really want to go long, right? So we're starting to be aggressive. We want to be aggressive now with, especially with that COT layout. So you can see price is kind of following that kind of, right? And this is a true seasonal period that is very, very strong. So very, very strong. So mid-July, even more so, but already starting from end of June and then end of June stretching all the way to August, almost big buy point, right? Big, big, big buy point. So we may see a true seasonal alignment here with COT, which is the perfect picture for us. So what are we gonna do is we're just gonna look at our lower time frames. Gonna copy that over for a second. So first our help lines. 1307 is going to be the low. Here's going to be where the low starts, and then it goes all the way to 2032, 1032. So here's my window of opportunity. Okay, here's my window of opportunity. So what's the first candle that's gonna really jump into my eyes here is kind of this one. And then here we would have a level that is kind of narrow, right? It's super narrow. And so here I would be willing to maybe just go down a bit. Here also we have a gap, so at least cover that gap here. And then also put this on the wider version just to make it bigger. So now it's like 25, 30 points wide. Okay, we can work with that. It's not ideal, but we can kind of work with that. So let's check our zone qualifiers here. And I think I need to pull them over. Departure, yes, it's an explosive move. Base, we've got 1, 2, 3, 4, 5 candles in the base. Yes, freshness for sure. Price has never been there. Originality and flip, it is original, right? It is original, and it may be a flip as well. Let's see. Looking to the left. Okay, this was an all-time high at that point. So this was an all-time high at that point. This was an all-time high. So it's no flip. And now do we have a level on top of level? Yeah, we have a lot going on here below as well. And mind you, we are now 160 points below price already. And by the end of this month, in 1 or 2 weeks, we want to be buying already. So it will take a miracle for price to get there, but we're going to do the exercise regardless. So what I will do is I will look at that prior pivot here, and I will put in a kind of a level that I find here. Okay, kind of like, okay, I see a drop base rally, or maybe an overall rally, base rally. Because here, if I go here now, I have a level on top of level. And, if I had drawn this level here like this, maybe this is a little bit clearer in terms of a level on top of level, but it's also not as pretty. I agree with that. And price is so far away, right? Price is so far away. This down here looks really pretty, but I'm going below my low, and I'm, price is so far away. So yes, this is nice. Like, we could put it in, but how realistic is it that price is going to go there in the next week or two? Very unrealistic. So in this case, I have kind of a level on top of level, but it's also a tricky one. I would agree with that in terms of seeing that and putting that in. Kind of all of this is kind of, wow, what do we do with all of that, right? We see something is going on here. It's basing, and then it's going higher eventually, but it's kind of tough. We have a market timing problem here for sure. So what we can conclude on the daily is we have a clear market timing problem. Which then what we're going to do if we have a market timing problem is, rather than continue to look at these rules, if I have a market timing problem, I'm going to go into my toolbox and I'm going to go to price action. And price action will then give me a way of timing the market with additional price confirmation. Okay. So price action, there's a course also that Tobias is creating at the moment. If you go within your classrooms, I'll just guide you towards that. If you go within your classrooms, here is a OTC price action, including campus indicators. If supply and demand comes to an end, right? If there's either a zone that's way too wide, it gives me no profitability, or there's way too much noise, I have market timing issues, then I'm going to resolve that through looking at price action. And then price action is going to give me an additional way of market timing, additional way of entering the market with additional price confirmation. Okay, so that's what we may have to do. Or alternatively, if we're going to look at that, right, and we're going to say, well, price should be turning here somewhere, and then if price is here, I'm going to look at daily demand, and you're going to buy the first daily demand, or you're going to buy, or price may be from here now, right, moving higher, creating new demand on a daily .d, and then you're going to buy the new pullbacks of those newly formed demand areas. And whenever on the daily there are pullbacks into newly formed demand from here to August, then you're going to buy these newly formed demands there, right? So that's also an alternative. But this is a very good example, because this is also where supply and demand, sometimes there's a limit to how much we can do with supply and demand, because we're not gonna, we have to work with what the charts are giving us. And if the charts are imperfect and noisy, then supply and demand, by looking just at supply and demand, we'll have a tough time timing the market. If we have a tough time timing the market, then we'll go into looking at our price action set of rules. All right, that's all for precious metals. Hope to see you in the next one. Happy and safe trading. Thanks for watching, and ciao.